Have you ever wondered why the Relative Strength Index, or RSI, often get the bad rap? It's because most traders misuse it, treating overbought and oversold conditions as absolute buy and sell signals. But what if I told you there's a more effective way to use the RSI indicator, one that combines it with other technical analysis tools to create a reliable trading strategy? The RSI indicator measures the speed and change of price movements by comparing the magnitude of recent gains to losses. It's a momentum oscillator that ranges from 0 to 100, with higher values indicating overbought conditions and lower values indicating oversold conditions. However, the RSI is not a standalone indicator, and relying solely on it can lead to false signals and significant losses. So, how can we use the RSI in a more effective way? One approach is to combine it with a trend-following strategy, using the RSI as a confirmation tool to support our trade entries and exits.